Today, I'm ranking the top income ETFs using a strict, no-nonsense scoring system using my secret proprietary algorithm. You see, income ETFs, they certainly are a powerful tool to help investors not only reach financial freedom, but also stay retired. The worry, though, is that not all income ETFs are made alike. Some are considerably better than others. Some might actually spell doom for investors and make their retirement quite short. And you don't want a short retirement. You've worked way too hard in your career to reach this point. You don't want anything to mess that up. So some of the criteria that we're going to be using in our power rankings include the performance of the ETF since January 1st. I usually make these power rankings videos about every 6 weeks, so it's been about since New Year's since I made the last one. We're also going to be looking for the dreaded words that I hate to say. No, NAV erosion. NAV erosion is bad. If the ETF price just keeps going down after every single dividend, then we're not really making any money, are we? With income ETFs, the goal isn't necessarily to be having the price keep going up and up, but it should be going up over time. That will definitely outpace inflation. Keep those dividend payments going strong. Remember, the NAV is directly correlated with how big those dividend paychecks are going to be. So we don't want any NAV erosion, and we certainly want it to be going up over time, but it doesn't need to be going up more than like the overall return of the market. It just needs to be going up a little bit over time. Also, we want real dividends from profits on the options trading that it's doing. I can't believe I even need to say this, but some people in the comments, they're not very smart. So real dividends, real profits, those are then going to get cash flowed back to us, the income ETF investors. We don't want any dividend fugazis. We're not looking for any Mickey Mouse dividends. So lots of funds out there. Lots of them might advertise high yields, but that doesn't necessarily mean that you're getting a ridiculously high yield. There's usually some sort of catch. And then, of course, the last criteria is your comments. Guys, there's so many income ETFs out there. There is no possible way that I'm going to be able to keep up with them. So that's why I need you guys to let me know in the comments what your favorite income ETFs are. And I use those in my rankings consideration to rank them higher or lower. We're going to be going over 10 ETFs today, so let's get started. Number 10, T-SPY Tap Alpha. All right, so T-SPY is a very popular one in the comments, though I do think this one is slightly overrated. Since January 1st, T-SPY actually down a big amount. It's down 2.74%. This is a fund that was released in August of 2024, so it's just reached its 18th month anniversary. It has a 12-month yield right now of about 14.3%, so I know why it's very popular in our income ETF community. But remember, we don't want the price to be going down too much. So far, T-SPY has not experienced any significant NAV erosion. In fact, it's up 1.48% all time. It currently has about $250 million in assets under management, so lots of new money moving into this fund. So yes, the yield might be high, but lately it just has not been doing very high. And these power rankings, they definitely emphasize what have you done for me lately. It's not always what have you always done for me. So of the ETFs on this list, this is actually has the worst year-to-date performance. But that doesn't mean that all the momentum is gone from this ETF. There hasn't been much capital appreciation. Really, everything that you're getting from this fund so far has been with those juicy dividends. Right now, it's about 14.8%. That's definitely no walk in the park. Number 9, QQA by Invesco. All right, I want to make sure people understand that this fund is called QQA. There's a lot of very similarly named ETFs out there. In my last video, somebody got confused between this and triple QA, so very similarly named. Make sure you're typing in the right symbol. That makes a huge difference when you're making investments, guys. Double QA is down 1.98% year to date. It was released in July of 2024, and right now it has a pretty juicy yield of about 10%. That's the 12-month yield. That's a pretty good return. And all time, the fund is up 7%. Now, I get constant emails from different fund providers asking to be featured on my channel, but I turn down most of them. My rankings are very valuable real estate. Only the best get on here. So yes, there probably is more than 10 great income ETFs out there. So don't get too salty if your favorite income ETF isn't on here, if I rank them a little bit differently. It's very subjective. With QQA, you're getting a very juicy yield, 10% in dividend yield, very good. Year-to-date performance, it hasn't been very good so far. And the time in the market, it still has yet to reach 2 full years in the market. So we're going to be keeping an eye on this one, seeing how they continue to do. But so far, very impressive, low expense ratio. That's why it's ranked a little bit lower on this list, but that doesn't mean it's not a great income ETF. Number 8. iSpy iQQQ by ProShares. See, I told you a lot of them are going to be similarly named. So iQQQ by ProShares, this is the NASDAQ 100 high income ETF. As its name suggests, they're going to be targeting high income on the NASDAQ 100, and they do all the work for us. Just another great aspect of these income ETFs is that somebody does all the work for us in exchange for that expense ratio. So iQQQ is down 1.97% since the year has started. iQQQ is down 1.97% since the year has started. It's about to hit its second birthday. It was released in March of 2024. Another very juicy yield of just about 10%. And all time, this fund is up 6.61%. Now for providers, if they also have another great income ETF, I do them in tandem. So it's not only just iQQQ, but iSpy as well. This is another great ProShares product. So year to date, this fund is down 24 basis points. Released in December of 2023. It has a little bit lower of a yield at 8.4%, and its all-time return is 13.27%. Now, iSpy is going to be targeting the S&P 500. You're going to notice I don't really talk a lot about the strategy of these funds in this video. That's because for a vast majority of these funds, I've already made individualized videos that go over way more detail on how the fund works. So be sure to check those out. Just search them on my channel if you're curious about these funds and if I've already made a video on them. So this ProShares duo is doing pretty hot. It's about the middle of the road, no extreme strengths to offset their weaknesses. About average capital appreciation. Year-to-date performance has not been very good so far. And the yield is solid, but not super high. Speaking of getting high, yeah, I don't really have a good transition for that. Number 7, QDPL, Pacer ETFs. So the Pacer Metaurus US Large Cap Dividend Multiplier 400 ETF, by far the greatest name on this list. This is an ETF that hopes to get dividend exposure by recombining the components of the S&P 500 with 4 times the dividend yield and get less overall S&P 500 index exposure. So guys, when you buy these income ETFs, they're not all made the same. Some of them are doing very different strategies. Some of them are doing very similar strategies. There's a little bit smaller nuances that separate all these. That's the great thing about having options. This is a 3-star rating on Morningstar. QDPL so far year to date has a 31 basis points negative return. This is a little bit older of a fund. It was released in July of 2021. So it's been out for almost 5 years so far. 12-month yield of 5.2%. It's not that great. And then its dividend frequency is only every quarter. For some people, the dividend frequency is like the biggest deal for some reason. For the rest of us who know how to budget correctly, it's not really that big of a deal. All time though, this fund is still up 23.52%. So that's some great capital appreciation. It's showing that even in different market conditions, the fund has still found a way to go up. That's why if you bought a brand new fund recently, some of the turbulence that we've been having in the market since the year has started is actually not a bad thing, right? It allows you to kind of really test some of these ETFs, see if they're going to be able to handle rough markets. Because if you think what we've had lately is rough, man, you're going to be in for a tough time when the markets actually do get rough. And if these income ETFs can keep paying juicy dividends. All right, so QDPL, it has a pretty low yield. Capital appreciation is really good. Year-to-date performance is still negative. That's why it's only number 7 on this list using my proprietary algorithm system. Number 6, SPY iQQI by Neos Investments. So try not to get too confused. This is actually a different income ETF than the ProShares one that we talked about. The other one was iQQQ. This is QQI. See, I told you we're going to have lots of very similarly named, because one thing in this income ETF space is that a lot of these funds, they're not very creative with their names. But it doesn't matter as long as they are creative in giving us dividend monthly cash flow. All right, so this NEOS product was the award winner for the best new active ETF in 2025 by the very prestigious ETF.com. That sounds like a very juicy honor, and that goes along great with QQI's super juicy yield of 14.3%. This is getting a lot of people on notice. This is why so much money is moving into these funds. Honestly, I do think NEOS is one of the best income ETF providers out there. They've done such a great job putting out a lot of great products. QQI was released in January of 2024. It's down about 2.5% to start off the year. We've already talked about its very impressive 14.3% 12-month yield. Overall, though, the fund is still up 4.63% all time. But not only is it paying out super juicy dividends, it also has some great capital appreciation. Now, its partner in crime, SPY is also another very impressive ETF. So in 2026 so far, they're down 65 basis points. This is a fund that was released in August of 2022, so it just turned 3.5 years old. It has a 12-month yield of 11.8%, so that's about getting a 1% return on your money every single month, which is absolutely insane. That is a great way to build generational wealth if it continues to give those super juicy yields and also not experience any NAV erosion. So far, it's up 7.38% in the years that it's been released. That does lag the overall market, but that's okay because with income ETFs, the goal is not necessarily to get capital appreciation. It's to get consistent, reliable dividend income that one can use to actually pay their bills. You can see a lot of money has flown into these NEOS products, almost $8 billion, and that's totally deserved because they're putting out some of the best products out there for us. You can see why so many Seeking Alpha analysts have this as a buy, non-stop buy recommendations. Guys, if you haven't liked the video yet, or subscribed to the Citizen of the Year channel, or left a 5-star review for the Collect Cash podcast, what are you doing? Number 5, Bali BlackRock. All right, for this ETF, make sure you actually type in Bali ETF. I accidentally put in Bali WTF. Yeah, totally different search results. All right, so Bali was up 51 basis points since the start of the year. This is a fund that was released in September of 2023. They have a little bit lower of a dividend yield, 12-month yield of 8.49%. So pretty solid, but not super juicy. But one thing that Bali really does well in is that their capital appreciation is up 28.64% all time. That's really good. That shows that this fund consistently has been able to pay out dividends, keep that NAV intact, and reward its shareholders very well. So when you buy Bali, you're also buying a piece of some of the biggest companies in the world. You can see they own a lot of the Nvidias, the Microsofts, the Apples, the Amazons, so a lot of the big tech giants. Also some blue chip companies in here like Johnson & Johnson as well. You're getting active management here, and you're paying a pretty low expense ratio of 35 basis points. Number 4, QDVO, IDVO, Amplify ETFs. All right, if there's one ETF that is the most hottest right now in the community, that is the IDVO by Amplify. This is actually an international fund, so it doesn't invest in U.S. companies. Well, actually, it somehow does invest in a little bit of U.S. companies, despite being called an international fund. I guess the U.S. is technically international, depending on where you live. Get this, guys. Since the year has started, IDVO is up a mind-boggling 11.5%. Keep in mind the overall S&P 500 is actually flat for the year so far. So to be outperforming it by nearly 12 basis points 6 weeks into the year, and then also paying out a 5% dividend yield, that is absolutely insane. That's the power of income ETFs. You get some of these better high quality funds and they will do amazing things like this. Or this just shows the rest of the world is catching up to the United States. But for now, IDVO is absolutely dominating the overall stock market, period, not just income ETFs. Amplify's other super juicy product, QDVO, is down 3.45%. Maybe it should take some lessons from its brother IDVO. IDVO was released in September of 2022. QDVO has been out since August of 2024. It does have a little bit higher of an overall yield here, 10.46%. It's actually over double that and it has over $500 million in assets under management. Let's see what IDVO's is. It's actually getting close to that $1 billion mark, which is very well deserved. If you guys remember, at the start of the year, I actually made a video about IDVO. That's another reason why you guys need to make sure that you're subscribed so you're catching all these video updates. Just looking at their 1-year chart, do you wish that you had bought here at all-time highs, or do you wish you had found out about this fund a long time ago when you could have gotten in at much cheaper? All right, so these Amplify products have had absolute explosive upside. They've done very well recently, at least IDVO has, but since QDVO hasn't done as hot, I'm gonna have to rank them a little bit lower. They just missed out on the podium. Before we get into the podium, what if there was a way to get access to my full $350,000 portfolio and all my weekly stock trades that have been beating the market for the past 5 years? Well, you're in luck, because by becoming a Patreon member, which is actually super affordable, by the way, and it's available for all those who want to take investing to the next level. Number 3, GPIQ, Goldman Sachs Asset Management. All right, so number 1 has been dethroned. I can't remember the last time that the Goldman Sachs ETFs didn't rank number 1 on my power rankings, but that just kind of shows that it's been a little bit rough start to the year, or the other 2 funds on this list have just done that much better. So GPIX was down 1.02% so far to start off the year. This is a fund that came out in October of 2023. They have a yield of 8.18%, which is solid, and they're actually up 33.91% all time, which is absolutely phenomenal. GPIQ, on the other hand, is down 2.8% to start off the year. It has a 12-month yield of 10.24%, and it is up 32.51%. So both of these funds, whether they track the NASDAQ 100 or the S&P 500, they have somewhat similar stats to some of the lower ranked funds on this list. The only difference is that the capital appreciation with these 2 Goldman Sachs products is considerably better. That's why you definitely know that management is doing a really good job. And they actually charge a very low expense ratio for these funds. Having an expense ratio of 29 basis points or 35 basis points is super low. Doing options trading by yourself requires not only a lot of time, it requires a lot of capital. And as somebody who personally does a lot of them now in my own personal investing journey, it's definitely nice to have somebody do all the work for you for super cheap. So very solid yield, excellent capital appreciation, but the year-to-date performance is why this Goldman Sachs duo is no longer number 1. Number 2, JEPQ. JP Morgan Chase. All right, I'm sure this is going to ruffle a few feathers, but JEPI is up 3.62% since the year has started, and this is a very time and tested ETF. Get this, it was released May of 2020, so it's about to hit its 6th birthday. That is one of the oldest income ETFs that has done this great, definitely the oldest on this list. It has a 12-month yield of 8.03% and is up 18.4% all time. JEPQ, on the other hand, that's the one that's a little bit more focused on the NASDAQ 100 stocks. It is down 1.05% to start off the year. It has a 12-month yield of 10.69% and is up 16.87% all time. A lot of people on my last video were really hating on JEPI and JEPQ. They were basically making it sound like I had committed a crime by even putting them on my list. Guys, you know crime doesn't get persecuted these days. Now guys, before I go turn myself into the local authorities for ranking JEPI and JEPQ on my own personal power rankings video, let me explain why. When you are in retirement, you don't want the latest flashy hot income ETF, the latest trend. You don't want that to be a considerable amount of your portfolio. I don't care if it's returned an 80% yield so far in the 6 weeks that it's been out. What I want are time and tested products that are consistently been shown to give you great dividend payments and not have NAV erosion. Sure, past performance might not necessarily be indicative of future performance, but what it is indicative of is that the past fund managers practiced a strategy, and that strategy allowed them to be good stewards of our money and practice that dividend ship to take care of our money. When I'm old and retired, I don't have the time, energy to go back into the workforce. So that's why I really put extra emphasis on keeping my money there. That's why JEPI and JEPQ continue to remain ranked so high. That's because I don't doubt the time and tested products. JEPI has been out for a very long time now, and they've consistently not only had no NAV erosion, but continued to pay out some juicy dividends. I don't care that it didn't do that great in 2025. I'm not a short-term investor. I'm not constantly trying to flip stocks and ETFs in my portfolio. A lot of you guys wanted me to drop these two in favor of some new flashy ETF that had just been released. Any product can look good in the short term. That doesn't mean anything. It's not that hard to do. What is really hard to do is to have 6 years of continued excellence. With these two products, you're getting a solid yield, you're getting a very strong momentum play, and the stability is what makes this a very solid number 2. Now, I was very close to being extra petty and putting it number 1 just to spite people, but number 1 is reserved for number 1, RDVI TDVI First Trust. All right, I doubt many of you have even heard of some of these funds before, but I have made videos on them and they continue to be excellent. Let's start off with RDVI. Get this, year to date, they're up 3.5%. This is a fund that was released in October of 2022, and it has a 12-month yield of just under 8%. But where this fund really shines is that their capital appreciation is at 33.81%. Very good fund so far. You can see they're very close to $3 billion in assets under management. Lots of Seeking Alpha analysts continue to rank this as a buy, or maybe the same guy puts out the same article about every 3 months. But hey, he might be a number 1 fan of the number 1 ranked income ETF in this edition's power rankings. It's had a really good start to the year so far. And then when we look at TDVI, its sister fund, this fund is up 2.42%. It was released in August of 2023. It has a 12-month yield of 7.5%. And get this, guys, capital appreciation of 43.98%. One could actually make the case, are you even getting an income fund or are you getting a growth fund with this? It's absolutely dominated the stock market since it has been out. It's a shame that it only has $286 million in assets under management. Honestly, it should be ranked a lot higher. We got our old buddy Kane Lee continuing to recommend it. So this is really a test of how the funds have done over time. You can see that most on this list were actually in the negative. The stock market's been about flat to start off the year. Should be good news for income ETFs. That means that a lot of those covered calls won't get blown away, and one should be able to get those dividends, continue to collect them, and just stack up cash flow. All right, I'm sure we're going to be very civil in the comments. Let me know what you think of these power rankings. They're always very fun to make, but they do take a lot of time. So make sure you've hit that like button. Make sure you're subscribed. Make sure you leave a 5-star review on the Collect Cash podcast name. And remember, all my Patreons, they get full access to my $350,000 portfolio and all my weekly stock trades.
Salvatore Navora, Zorab Mikoladze, Leopig Leonor, Nicola Caputa, Sultan Ahmed bin Sulayman, CEO of Dubai Ports World, and billionaire businessman Leslie Wexner, who was labeled as a co-conspirator by the FBI.